when everything you see is an illusion, a deceptive reality, deliberately fabricated to mislead you? Can you feel secure about the money you've worked day and night to earn? And when you realize this deception may be coming from the world's most powerful government, do you continue to look the other way, or do you take action to protect yourself? Hello everyone, and welcome to Stewardship Finance Academy, the channel for building confident investors. Several major events have unfolded recently that demand our attention. The legendary investor Warren Buffett has had a challenging year, with reports showing his second quarter profits dropped significantly. Now this is the Oracle of Omaha we're talking about. If someone of his stature is finding it difficult to generate returns, you'd assume the market is in turmoil. And yet, after a dip in April, the US stock market has rallied, hitting new highs. It seems the market isn't failing. It's the titans of finance who are being left behind. It appears almost anyone buying stocks could have seen better percentage gains than the masters of the universe. That's why you hear people saying Warren Buffett is past his prime, more focused on retirement than on making moves. This narrative gained traction after he sold off positions last year, leaving him with one of the highest cash percentages in his firm's history. But as you process that, you'll notice it's not just Warren Buffett. Other giants of Wall Street seem to be on the sidelines too. Think of Jim Rogers, who also reportedly sold all his US stocks last year. So did Ray Dalio, the head of Bridgewater Associates, and even Jamie Dimon, chairman of JP Morgan Chase. These influential figures didn't just sell a large portion of their available stocks. They also appear to have missed the opportunity to buy the dip during the 20% market correction in April. So, let's be fair, if we're going to critique one, we should critique them all. The big players have seemingly been outmaneuvered by everyday retail investors. Hold on. Let's think about what the Federal Reserve uses to guide its interest rate decisions. One of the most critical indicators is the non-farm payroll data, which essentially measures how many Americans are getting jobs. Historically, a figure above 100,000 new jobs suggests the US employment market is strong. Below that number, it signals potential economic trouble. Now, let's look at the data for May and June of this year, which initially showed increases of around 140,000 jobs each month. The consensus was that the US job market was thriving and the economy was on solid ground. But then, the report for July was released, and it told a different story. The data indicated only a little over 70,000 new jobs were created. You might be thinking, so what? It's just one disappointing month. But the story doesn't end there. The real bombshell was a revision to the previous month's data. The report revealed that the initial figures for May and June were significantly overstated. With revisions this drastic, can we trust the unrevised July number of 73,000? For us, as business people and investors, the key takeaway is this. We've now had 3 consecutive months of employment, figures far below the 100,000 job threshold. After the revisions, the numbers are barely positive. This means that hundreds of thousands of jobs, which appear to have been created over the past 3 months, effectively vanished into thin air. What does this imply? This wasn't a discovery I made. This was information released by official sources. It was reported not only that the data was inaccurate, but also that the director responsible for the statistics was subsequently replaced. So, what does this sequence of events suggest? It creates the appearance that a goal has been achieved. The people who were meant to enter the market have now done so. If that's the case, there may be no more need to present a strong economic front. This could mean that the US economy we see going forward will be a more accurate and likely weaker picture. The non-farm payroll data in the coming months could be very revealing. So, does it still look like capitalists like Warren Buffett, Ray Dalio, Jim Rogers, and Jamie Dimon have lost their touch? Or is it possible that these architects of the financial system were waiting for a trap to be set, and the spring is about to be sprung? The music is slowing down. Do you have a seat? The world often has a way of balancing the scales. It's just a matter of time, and it feels like that time is approaching. If you do, and want to be caught on the wrong side of this shift, and perhaps even hope to use this moment to your advantage, you might want to subscribe to my channel for more information. If you're concerned you might forget these details, you can like this video, and it will be saved to your playlist for you to review anytime. First, let's think about this logically. After the April market correction, we saw employment data for May and June that suggested a strong US economy. This likely encouraged investment in US stocks. But to push stock prices up, you need capital. Where did that capital come from? Remember, when you buy US stocks, you first need to convert your local currency, whether it's the new Taiwan dollar, Malaysian ringgit, Japanese yen, or the euro, into US dollars. This is why an index even more important than the stock market is the US dollar index. A rising dollar index suggests global capital is flowing into US assets. Conversely, a falling dollar, as we've seen for much of this year, suggests money is flowing out. Herein lies the puzzle. We've heard announcements of massive investments into the United States from Japan, with a reported $550 billion, Europe with $650 billion, and South Korea with $350 billion. And yet, the US dollar index has only seen brief rebounds before continuing its downward trend. With the US stock market and economy appearing so robust, shouldn't global capital be flooding in? Why is the dollar still near its lows? Furthermore, the US debt ceiling was recently raised, allowing the government to borrow nearly another $1 trillion almost instantly. The national debt is now approaching $37 trillion. If the US government borrows $1 trillion from the market, that means there's $1 trillion less in circulation for everything else. This alone could be enough to trigger a market correction. But not only did the market not crash, it seems to have become even more liquid. How is this possible? It appears the US Treasury has adopted a new strategy, issuing short-term debt. Here's how it can work. Step 1. Capitalists buy T-bills and then pledge to banks for cash. Suppose you have $1 million and you buy a 1-year US Treasury bill. At the end of the year, the government returns your $1 million plus, say, $50,000 in interest. A typical person would wait the year and collect their $1.05 million. But a large-scale capitalist operates differently. They might take that T-bill, which is worth $1.05 million at maturity, and use it as collateral to borrow, for example, $950,000 from a bank. The bank sees the T-bill as a low-risk asset. If the borrower defaults, the bank gets the T-bill, which the US government will pay out. So the capitalist gets $950,000 in cash to invest in stocks or other assets, while still being positioned to earn the interest from the T-bill. The chain doesn't stop there. Step 2. The bank can then take that same T-bill and pledge it to the Federal Reserve to get, say, $970,000 in cash. In this transaction, the bank immediately frees up its capital and makes a small profit. The Fed, in turn, acquires a government-backed asset. Through this IOU game, idle funds are put into motion. So the $1 trillion the US government needed to borrow is smoothly absorbed, and the market doesn't seize up from a lack of liquidity. This mechanism can even be amplified. Capitalists could use that borrowed $950,000 to buy more short-term bonds, pledge them again, and repeat the cycle. This is how $1 million in initial capital could potentially be leveraged to control $20 million in assets. This is the world of leveraged funds and what some call shadow banking. The issuance of short-term debt, in effect, creates a new channel for liquidity to enter the market. So let's reconstruct the narrative that emerges from these events. Following a market downturn, a picture of a booming economy is painted, supported by what we now know were flawed employment statistics. Simultaneously, a flood of liquidity is channeled into the market through the banking system, fueled by short-term government debt. This drives up asset prices. Countless investors, seeing the rebound, jump in, some using significant leverage. And now, at this moment, the government publicly clarifies that the employment data was inaccurate. You have to ask yourself, what is the purpose of this timing? The answer that presents itself is a classic maneuver. Lure them in, then spring the trap. Do you think a long-term buy-and-hold strategy can protect you if a leveraged bubble, or even a broader financial crisis, is on the horizon? When the market tide goes out, even the strongest companies can be pulled under. This is why a comprehensive investment strategy is as important as picking individual stocks. It's about waiting, observing, and seizing opportunities. When the trend provides a favorable risk-to-reward ratio, your method should allow you to compound profits while having a built-in margin of safety, so that even if you're wrong 4 times but right once, you can still come out ahead. We only need one robust system that can be applied to any asset class. If you haven't learned such a system, I urge you to join our stock investment class by clicking the first link in the description. For my fans, registration is currently free, but I have to let you know this free class will be discontinued soon. What does it mean to lure them in and spring the trap? Most of the news you see focuses on the strong rebound in US stocks, but rarely mentions the weakness in the US dollar. The stock market and the dollar are like fire and ice. The purpose of a rising stock market is to attract global capital. US stocks are the product. When they rise, people want to buy US dollars to get in on the action. This is the lure. Let's look at the first group of investors who were lured in after the April correction. US stocks looked like they were on sale. We were told tariffs were suspended, and the non-farm payroll data was strong. So, people sold their local currencies to buy US dollars and invest. But what happened to the dollar? For investors in Taiwan, for example, the US dollar may have depreciated by as much as 15% against their currency. This means that just on the currency exchange, a $1 million investment could have lost significant value before a single stock was even purchased. The same dynamic played out against the euro, the Malaysian ringgit, and other currencies. You were losing on the exchange rate before you even started. Now we see the second phase. The US dollar has fallen significantly, while the stock market has rebounded. This makes many people feel the worst is over. Fear of missing out kicks in, and they rush to buy stocks, thinking it's now a safer and more cost-effective time to invest. But just as this second wave of investors has entered the market, The US government announces that the employment data was flawed. We're told the economy has actually been weak since the correction, that the market rally was fueled by leverage, and that tariffs may be reimposed in August, a month that historically tends to be volatile for stocks. Doesn't it feel like all of this was just waiting for the maximum number of people to be in the market? If US stocks correct again, both groups of investors, those who bought the dip and those who bought the rally, could be trapped. This is the springing of the trap. And what might come next? With a struggling economy, the Federal Reserve could be pressured to cut interest rates, or even restart quantitative easing to support the market. Then, stocks could rise again. This is why I'm currently cautious about US stocks. People sometimes assume we are bearish on the US market, but that's not true. Our primary focus is US stocks, and we want them to perform well. But timing is everything. In 2023 and early 2024, when the dollar was appreciating and the stock market was in a clear uptrend, we were fully invested. It was only in late 2024 that we began to take profits and reallocate that capital into other assets like gold, Bitcoin, and certain international stocks that were showing strength. I sincerely invite you to think about the ideal conditions for investing. In US stocks, there are 4 basic scenarios. 1. The dollar rises and US stocks rise. 2. The dollar falls and US stocks fall. 3. The dollar rises and US stocks fall. 4. The dollar falls and US stocks rise. The best time to invest in US stocks is when the dollar and the market are both rising. Otherwise, you're fighting a headwind. Even if stocks go up, a falling dollar can erase your profits. The worst-case scenario is when both stocks and the dollar are falling, so even with the recent market rebound, the plummeting dollar makes me hesitant. The key isn't to become a financial expert overnight. It's to align your thinking with a sound investment philosophy and methodology that you can apply to your own situation. If you haven't watched our free stock investment class yet, I encourage you to do so while it's still free and available. The logic in our videos is interconnected. If you haven't seen the last few, you might think I'm just explaining things after the fact, but many of these points were raised weeks ago. The situation is likely to become even more turbulent. If you don't want to miss it, please subscribe and turn on notifications. I sincerely wish all of you who like this video a speedy journey to financial freedom. If even 1 or 2 things I've said today can help you live a better life, I'll be satisfied. Okay, see you next video. Bye.